If you are interested in algorithmic trading, you may have wondered which type of financial instrument is better for your strategy. Contracts for difference, CFDs, or futures. Both CFDs and futures are derivatives that allow you to speculate on the price movements of underlying assets without owning them. However, there are also some important differences between them that can affect your trading performance and profitability. In this video, I will compare CFDs and futures in terms of their advantages and disadvantages, and provide some tips on how to choose the best option for your algorithmic trading goals. What are CFDs and futures? CFDs are agreements between a buyer and a seller to exchange the difference between the opening and closing prices of an underlying asset, such as a stock, commodity, currency, or index. CFDs are traded over the counter, OTC, meaning that they are not standardized or regulated by a central authority. Instead, they are offered by brokers who act as market makers and set their own prices and spreads. CFDs are leveraged products, meaning that you can trade with a small amount of capital and magnify your potential returns or losses. Futures are contracts that oblige a buyer and a seller to buy or sell an underlying asset at a predetermined price and date in the future. Futures are traded on regulated exchanges, meaning that they are standardized and transparent. The price of a futures contract is determined by the supply and demand of the market participants. Futures are also leveraged products, meaning that you can trade with a small amount of margin and control a large amount of the underlying asset. Advantages and disadvantages of CFDs. One of the main advantages of CFDs is their flexibility. You can trade CFDs on a wide range of underlying assets, including stocks, indices, commodities, currencies, cryptocurrencies, and more. You can also trade CFDs on both rising and falling markets, meaning that you can profit from both bullish and bearish scenarios. Moreover, you can trade CFDs 24 hours a day, 5 days a week, giving you more opportunities to catch market movements. Another advantage of CFDs is their low cost. You do not have to pay any commissions or fees when trading CFDs, as the broker makes money from the spread, the difference between the bid and ask prices. You also do not have to pay any stamp duty or taxes on your profits, as you do not own the underlying asset. Furthermore, you do not have to pay any delivery or storage costs for commodities or currencies, as you do not take physical possession of them. However, CFDs also have some disadvantages that you should be aware of. One of the main disadvantages of CFDs is their high risk. Because CFDs are leveraged products, you can lose more than your initial investment if the market moves against you. You also have to pay interest on your leveraged positions, which can reduce your profits or increase your losses over time. Additionally, you have to deal with the risk of slippage, the difference between the expected and executed prices, and requotes, when the broker rejects or changes your order price, due to the volatility and liquidity of the market. Another disadvantage of CFDs is their lack of transparency. Because CFDs are traded OTC, you have to rely on the broker's prices and spreads, which may not reflect the true market conditions. You also have to trust that the broker will execute your orders fairly and accurately, as there is no central authority to oversee or regulate their activities. Moreover, you have to be careful about the broker's terms and conditions, as they may impose hidden fees or charges on your account. Advantages and disadvantages of futures. One of the main advantages of futures is their transparency. Because futures are traded on regulated exchanges, you can access real-time market data and prices that are determined by the collective actions of all market participants. You can also see the volume and open interest of each contract, which indicate the liquidity and activity of the market. Furthermore, you can benefit from the clearinghouse system, which guarantees the execution and settlement of your trades and protects you from counterparty risk. Another advantage of futures is their standardization. Because futures are standardized contracts, you can easily compare them with other contracts or instruments based on their specifications, such as contract size, expiration date, tick size, margin requirements. This makes it easier to assess the risk and return of different trading strategies and to hedge your exposure to market fluctuations. Furthermore, standardization also facilitates liquidity and transparency in the futures market, as traders can access the same information and prices for any given contract. Conclusion. CFDs and futures are both powerful tools for traders who want to speculate on the price movements of various assets without owning or delivering them. However, they have different characteristics and implications that traders should understand before choosing one over the other. Algorithmic trading can help traders exploit the advantages and overcome the disadvantages of both types of derivatives by automating their trading orders based on predefined rules and strategies. However, algorithmic trading also requires careful testing, monitoring, and updating to ensure its effectiveness and profitability in different market scenarios. Thanks for watching. If you enjoyed this video, please hit the like button and subscribe to my channel for more content like this. Until next time, happy trading!